So the reason you clicked in this video is likely because you are interested in investing, and I would imagine that you're probably interested in beating the S&P 500, because aren't we all? But the problem is that we're constantly being bombarded on social media and the internet any way, shape, or form with tons of different ways to invest or beat the S&P 500. And what it ends up doing is it actually spreads us super thin. So we get into all these different strategies or styles of investing, and we don't focus on one thing. And if you've experienced it yourself, you're like, man, I try all these things and here I am with less money than what I had to start, but the market's gone up. I fell into the same trap myself, and not only did it cost me 50+% in a fairly short period of time on the S&P 500 alone, that could have just literally been a buy, set, and forget, but it also cost me a fuck ton of time, because you waste so much time learning about this investment strategy and then these ETFs and these stocks and trying to time the market in this way and then sector rotate. Like, you learn all these different things and you end up just getting, right back to where you started. Now, I'm not here to argue what method necessarily or like what stocks you should be putting your money in or which method is going to make you the most money, because it's certainly possible these things are talked about because someone probably did it, or the idea, or there's a theory that you could, in theory, do this if you were to, operate this way and everything worked in your favor. But I think for the vast majority of people watching this, there really is one simple solution that I have found to work the best for me. And for a lot of people, after seeing it, experiencing it myself, and then seeing what a lot of other people have done and how it's lost them a lot of money or wasted a lot of their time. But there is a slight twist that we can add to this to make this, in theory, a lot more profitable in the long run. But that little twist does not involve excess time, excess research. It's very, very basic and does not take very long to learn or understand, and will take you a matter of minutes, a month to worry about. Like, that is it. So what we should be doing is we should be going back to those original finance videos, the videos we all probably watch at some point, where they were telling us dollar cost average into the S&P 500. We should be going back to those videos and going, you know what? You were right. I thought I could do this and I thought I could do that, but you know what? At the end of the day, this video, you were right. Problem is, a lot of people in the finance space, they get sucked into the views and the output because it makes a lot of money that they need to keep supplying. And so new ideas. Oh, what about this? Try this. This is really cool. And so it ends up, throwing you for a loop, because the same person, or the person that you thought you looked up to who said, just do this, you'll be fine, is now saying, well, you could also do this as well, but you should probably do this still first. It's like, it doesn't help. But here is kind of like the way it works, at least the progression that I have seen play out in my life. Day one, you'll learn about investing. Dollar cost average. There's something called the S&P 500. There's something called dollar cost average. Oh my gosh. If I just slowly but surely continuously buy into the S&P 500, I will, hopefully make money over my lifetime. And if I've done that like many generations before me, they've all done very, very well and gotten very, very wealthy off of doing that consistently from a young age. Then we progress to, we can go buy individual stocks. Why would I buy the S&P 500 when I could buy stocks like Nvidia that can go up 500% in just 1 year and completely blow away the average 9-ish% that the S&P 500 returns? Suckers, I'm going to go buy Nvidia. Nvidia goes down, or it's very volatile, and you're like, okay, well, this is cool and it could do very well in a bull market, but I want some more stability. So you find REITs, real estate investment trusts, and income ETFs that might pay you every single month a nice fat dividend. And you're like, oh man, this is awesome. I'm going to be consistently cash flowing, which means I have more money to dollar cost average back in these positions, which will make me more money every single month. And I'm going to make even more money because I'm compounding so much faster than the S&P. And then you recognize that, okay, despite my dividends, these stocks or these ETFs can go down, and many times they go down to the same degree that the dividends. So I'm losing money on the return of my shares, but I'm making it back in the form of dividends. And so unless we're in a perfect environment, the markets are just slowly going up over time, I'm going to be netting pretty much where I started. And you find that it's maybe not as easy to beat the S&P with that approach. Then you find about these things called leverage ETFs, which are like the next hottest thing. Oh, well, you can get a 2 or 3x ETF on Tesla or on this thing or on that thing. And so I could buy or I could short the market when it's up a lot, and I could long the market when it's down a lot. And so when it returns to the mean, I'll make back so much more than what I would have if I just bought the actual stock or the ETF instead of the leveraged one, and I can make so much more money, and that can make me a lot more than the average returns of the S&P. Inevitably, that fails at some point. You lose money somehow, or eventually things come crashing down. Your strategy doesn't work as well, and then you move on to leaps. Let me tell you the leaps, because you don't have to worry about the short-term price action. You just go out a year, go out 2 years. I'm going to buy some Tesla leaps, and then Tesla doesn't do anything for 2 years, and your leaps go to zero. And so you thought you can leverage a little bit of money and make a lot of money, and now you're not. Then you look back at the S&P and go, oh my God, over those exact 2 years, I could have made 50% if I just had my money in the S&P and did literally nothing, and I wasted all this time. Oh my God, how crazy is that? Now we're back to dollar cost averaging into the S&P. You start DCAing into the S&P, we go into a 5-year bear market, and now you're down all over again, and you just keep repeating this cycle because you just keep on losing. Whereas you stuck to one thing, the main thing, the original thing, you would have made money in the first place. Timing the market aside, the dollar cost average of the S&P is a very, very good way to go about it. But the twist that you can add is very, very simple. Now, there have been a lot of research papers, articles. I'll actually link one up below this video. That's actually really cool. It compares a standard dollar cost average approach to like a dip buy approach and shows you that just depending upon different times in history, one approach will beat the other approach. And it's interesting. You would think the dip buy approach should win. Not necessarily. If you handpick the times to 30, 40 years here or there, you might find periods where that dip buy approach, depending on how you're operating it, won't work. So the twist that I want to layer in is kind of a best of both worlds approach when it comes to your investment strategy. There's really 3 levels to the game. Level 1 is simply dollar cost average the S&P. This is going to return you the average market returns, and you're just going to keep building up your wealth over time. There's not much to really worry about or talk about here. This can be set up automatically. This can be done in an IRA, individual brokerage account, however you want. You can have automatic withdrawals from your bank account once you get paid, and you can have automatic investments into whatever stocks or ETFs that you would like. So I would recommend an S&P or a total stock market ETF to kind of catch the whole thing there. And that's it. You can set that up and legitimately just check in every month to make sure the money is going in and out, like, make sure it's going in the right spots. That's it, which will take you like 2 minutes. Layer 2 is a strategic dollar cost average. Here is where you have your dollar cost average approach where you put money in, but you don't put all of it in. So let's say, just make it simple, in a given month, you deposit $1,000 into your investment portfolio. And that $1,000 gets put into just the S&P 500. So say you just go right to the S&P, or you buy a total stock market ETF. You just go one and simple, done. That's it. You buy SPY, for example, the S&P ETF SPY. Instead of taking that full $1,000 and buying that $1,000 in one shot, what you could do is you could break it up into 4 times per month to average it out. So buy on the 5th and the 12th and the whatever. You can, average it however you want to do it. Every month, boom, boom, boom. The money gets put in, and if it's a weekend, it goes the next Monday. And that's it. This will layer in your dollar cost average a little bit more evenly, so you might not get caught up in a situation where you always happen to be buying the highs of the month, which could be possible, but will average out over the course of years. But on top of that, you do not throw in all of your money. So what I mean by that is you have $1,000 that you put into your account, and each of those 4 dollar cost averages, you throw 200, 200, 200, 200. So you're like, okay, what do I do with the last 200? The last 200 is there for you to subjectively dollar cost average that into the markets. Now, this is where it gets a little more complicated, but if you understand basic math, basic probabilities, and basic stock market returns, you can pile up that cash and say, hey, if we are in a very strong bull market, I'm not going to deploy it. I want to utilize that for when we are in a bear market. And so when we have a bear market, you can then deploy that money when the S&P is down 10, 20, 30% off of its all-time high. I'm just using that as an estimate, but you can stockpile some cash in there, and maybe that percentage is a little bit too high, but a small portion of your cash to stockpile so that you have extra cash when we do have a bear market, when we do have a downturn, so you can deploy more of that into the market as it's dropping, which will return you more in the long run. Where that could do you wrong is if in longer periods of bull markets, you stash too much money on the sidelines, that money could have been deployed and been working for you throughout that entire bull market, and that could add up over time if it's a large percentage. Why I recommend a small percentage, but you can have it as a small percentage, which then you can utilize in those really bad days, whether it's really bad months, really bad years, or really, really bad days in the stock market where you're like, hey, I want to nibble a little bit more because the S&P is down 6% today, as an example, and I just want to buy a little bit more because my next dollar cost average isn't until next Tuesday. it could be something you want to do. And the third level is do the exact same thing that you were doing in level 2 or level 1, but now add in a final layer, and that is covered calls. Here is where you can utilize options, but not buying them, selling covered calls. So once you have 100 shares of your underlying ETF, in the case of our example, SPY, I could sell covered calls, and I can sell them every day. I can sell them every week, every month, every 2 months, every quarter, every year. Doesn't matter. The more often you sell them, the more work it will be. The farther out you go, the less work it'll be. But what you could do is say, hey, every month I'm going to log into my portfolio and I'm going to sell a covered call on SPY as long as we are up for a couple days in a row, or we are generally up. We're not generally going down, down, down. If we are up, options will be at a higher premium for a higher strike price. I'm going to go out 5% and sell a covered call 5% higher than where we're at right now, meaning the S&P would have to go 5% higher for me to get taken out on that covered call. All this is going to do is generate you a little bit of extra cash flow that could be your stockpile. That could by itself be the cash flow that you use to build up a little bit of a stockpile to buy in during bear markets or during bigger dips. That's how you can go about it. That is also subjective because you have to have a strategy. You can't just be randomly selling covered calls to try to make as much money as you can, because what you're going to find is that if you're trying to return a lot of money from the covered calls, you're going to have a lot of situations where you're going to have to buy them back or let them expire, get your shares taken from you, and then have to buy back into the market lower. If you're not sure how covered calls work, we have some videos on the channel, and there's plenty of videos on YouTube to learn about them. It's like the next level up, but once you understand them fundamentally, all you really need to care about is what the market's doing. Is it up a lot? Is it down a lot? If it's down a lot, probably don't want to sell covered calls. If it's up a lot, probably could sell covered calls, and there's a better chance they're going to expire worthless, which means you keep all the premium. That's all your money. And I would recommend you do not shoot for the moon. You're not trying to return 17% per year in covered call cash flow. You could. People probably can do it. It's more risky. But if you can return a couple percent per year on your portfolio, like literally 2 to 3%, that would be awesome. The risk would be fairly low, and that could be all it takes per year for you to drastically change the compound effect that you'll have on your portfolio over your lifetime. That is what it's all about. All while spending minimal time each month worrying about your investments. There you go. Save you some years, maybe some hours every single month, and maybe save you some money in terms of putting your money in a better place where you don't have to worry about it as much. To celebrate with our extra time, we can go out and utilize that to make more money, either take on more responsibilities, more jobs, whatever, more projects, start a business, I don't know. Do the things that you actually like to do with your newfound time freedom. Or maybe, just maybe, you drop a like on this video. I don't know. Be kind of cool. I'll see you guys next one. Peace.